People far too often pay more taxes in retirement than they need to, or get surprised by confusing rules they come into. And did you know that just $1 above certain income thresholds can cause your Medicare premiums to go up for a full year? In this video, I will tell you exactly what you need to know so that you know how to prevent it. I'm Dan Lohmar. I'm a CFP professional with United Wealth Management, where we specialize in PRAP management and financial planning for pilots at United Airlines. And like many of you, my business partner Alan Bewley and I are both pilots for United. Welcome to my video on Medicare and taxes. Now, if you want to learn how to manage your taxes and grow your money so that you enjoy the retirement you deserve and help your PRAP last longer, then subscribe now and hit the bell icon so that you know when new videos come out. So in this video, I'm talking about Medicare and taxes, or surcharges, and how to avoid the Medicare cost cliff. Unlike tax brackets where your taxes go up progressively with income, Medicare can impose a surcharge for an entire year if your income falls only $1 above certain thresholds. It's called IRMA, and you need to know what it's about. So how is it possible that $1 of additional income can cause Medicare premiums to go up for a full year? Well, Medicare has a base cost, and then it imposes surcharges if your income goes above certain thresholds. And unlike a tax, which is a percent of income, the Medicare surcharge is simply an additional higher cost. So going above these income thresholds by only $1 can cause a substantial increase in Medicare premiums for an entire year. It's literally an income cliff, not a marginal tax. This surcharge has the cute little name of IRMA, and it's very important to plan ahead for. The best way to talk about this is just to show you an example of how Medicare and IRMA can affect the early years of retirement and beyond. All right, so let's talk about Medicare costs and surcharges. Medicare has a base cost, and that base cost applies up to certain income thresholds. And then above those base costs, they apply these income monthly adjustment amounts. And those are the surcharges they apply as your income increases. I'll talk about what the base costs are here in just a minute. But it's a surcharge. It's not a tax. So if your income goes $1 above these certain thresholds, then they're going to increase your Medicare costs the entire amount. So it's IRMA, it's income-related monthly adjustment amount. Social Security Administration puts out a very good pamphlet that explains Medicare costs and what these surcharges are. I've got a link to this pamphlet in the video description on YouTube. And then here's just an example of the income thresholds, what the base amount is, and what these premium amounts are as your income increases. So the base cost of Medicare is, for Part B, it's $135.50 per person per month. And then Part D costs are dependent upon the plan that you choose. So in Part D is prescription drugs. So it depends on which plan that you choose. The thing I'll say about for United pilots is that United Retiree Medical, a lot of those plans include prescription drugs. And so a lot of United pilots don't have to enroll in Part D. So that's a good thing to know. So the base cost per year, $16.26 per year per person just for Part B, or $32.52 per year per couple. And again, that's just for Part B also. So the income base amounts apply up to these income thresholds. So $85,000 for single filers, $170,000 for married couples filing a joint return. And above those income amounts are where you start to get these IRMA adjustments applied to your costs. Modified, so the income, what they look at is modified adjusted gross income for Medicare purposes. It's total adjusted gross income plus tax-exempt interest is how they, what calculates into that for income purposes. And so just to explain a couple things, how this would look throughout the year if you're to increase or go above an IRMA threshold and another tax to go along with that. So let's just look at a hypothetical just to see what it looks like. We have Captain Joe and Jane. They're both 67. They're in the higher spending years, and their modified adjusted gross income for this year is $169,500. And they're enrolled in Part B only. They don't have any Part D costs because we'll just assume they're on the United Retiree Medical Plan. So they're right below the next IRMA threshold of $170,000 for a married couple. So let's just say in December of that year, Joe's not aware of this income threshold and he sells a short-term stock position for $1,000 short-term capital gain. So let's look at all the different ways that affects his taxes and his medical surcharges. So he pays, they're just above the threshold for the 24% tax bracket. So he pays 24% federal tax on the short-term capital gain. So in the ways it affects his Medicare is that his modified adjusted gross income is now $170,500, and then that puts them above the next higher Medicare IRMA bracket of $170,000, which increases his Part B costs $54.10 per month per person. And so their entire year adds up to an additional $1,298 in additional Medicare Part B costs. And again, we're going to assume he's not enrolled in Part D. So his total increase in taxes, federal tax, and Medicare surcharges is $1,538. And you could just say that's essentially 153% tax rate is what they get taxed on that $1,000 of additional income. When is this assessed? Well, the federal tax, as you'd expect, are due when he files his 2019 returns. And then Medicare costs, the increase of that is actually in 2021 because Medicare looks at your tax return from 2 years prior. And so when 2020, they're going to look at a 2018 return, which is the most recent one that's on file. And then when 2021 comes around, that's when they'll look at the 2019 return. So it's actually assessed more than a year away. Could he have prevented this from happening? Well, I think he could have. Just being aware of it is the big thing. So the 3 A's of a quality financial plan are accountability, awareness, and seeking the right advice. And to think if he is aware that this stock transaction would have put him above this threshold, probably could have done something else about it. He could have waited a month, maybe in January, because let's just say he sold this in December, and then in January for that year, maybe their income would be lower, so that could have made a difference. He could have possibly made a SEP IRA contribution if either he or his wife had self-employment income that would have reduced their modified adjusted gross income. Could have potentially donated appreciated stock to charity. And then in more of a rare situation was if his spouse was still working and not enrolled in Medicare yet, was on a high deductible health plan through their employer, they could have potentially donated to a health savings account to help reduce their modified adjusted gross income. So there's a couple things that could have happened. So I had mentioned this real quick. So what income does Medicare use, or what year do they look at when they're assessing your Medicare premiums? So they use the most recent tax return that the IRS provides them. So it's always 2 years behind. So in 2019, your Medicare costs in 2019 are based on your 2017 tax return. So that means when you're 65, they're looking at your income from age 63. When you're turned 66, they look at your income from when you're 64. And so what this creates is it creates the picture of a much higher income than what's actually happening when you retire. And what you can do for this is you can file the form SSA 44. It's called IRMA Lifechanging Event to lower your Medicare costs. And what it's for? It's for life-changing events, just like it says. Retirement, marriage, death of a spouse, and there's a few others listed on there. Anything income-related, you can't file it for, and it won't make any difference. So like the fact that he sold this transaction and that it's not typical of his income doesn't make any difference. So they're still going to assess the IRMA adjustment on there. And you have to file this each year that you think they're going to be looking at a higher income year. So a lot of folks do this right when they first go on to Medicare. They'll do it at the end of that year, and then they'll do it again the year after that. So you might have to do it 2 times just to make sure that they're looking at the right tax returns. I did hear a story of a United pilot who filed it one time and then didn't file it again. Their Medicare costs went up, and they weren't paying the higher costs. And then as a result, they ended up losing their Medicare benefits. So something to be very, very careful of. File this thing as many times as you need to. It's not a big deal. Some people say it's easy. Some people say it can be kind of a pain to get it authorized. But that's just the front page of it. There's about 5 pages to it. You can do this through your Medicare, your Social Security Administration office. You can file it by mail, or do it in person. And then you also need proof of the life-changing event. So when you retire from United, that means usually just getting a letter from the chief pilot's office saying, yes, this person is actually retiring, and they expect their income to go down because of that. Last thing I'll say about Medicare costs and surcharges are Roth conversions. So Roth conversions are something that you can look at doing in your first few years of retirement, between say 65 and 70 when your required minimum distributions start. And this can potentially lower your required minimum distributions from age 70 and a half, because if your RMDs get too big, then they can push you across this Medicare threshold when you don't want it to. And so that's just something to be aware of. So Roth conversions are a way to potentially lower RMDs and prevent crossing this Medicare threshold. And a lot of folks do that in their early years of retirement. And there's a lot of things that play into that also. It depends what your current tax bracket is and what you think it's going to be in the future. But this comes up a lot of times in discussions when you're talking about Medicare costs. Anyway, that's a summary of Medicare costs and surcharges, and I hope that gives you a good idea of what to expect from Medicare costs. As you can see, it pays to be aware of these Medicare IRMA thresholds. In the example here, a stock sale increased their Medicare costs far more than the gain of the stock itself. In this example, there were ways to prevent it, and number one way would be just to be aware of it. And remember, you can file Form SSA 44 to reduce your Medicare costs, but only for life-changing events. Now, my next video is about withdrawing money from different types of accounts in the most tax-efficient manner. And you will see that the order from which you withdraw from tax-deferred, taxable, and tax-free accounts can make a big difference in your lifetime tax bill. It may prevent income from surpassing Medicare thresholds when RMDs kick in, and it can affect how long your money lasts. And so that you know when that video comes out, go ahead and subscribe and hit the bell icon so that you get notified. I'm Dan Lohmar, a CFP professional with United Wealth Management, where we specialize in PRAP management and financial planning for pilots at United Airlines. On behalf of myself and my business partner, Alan Bewley, invest with a plan based on science and evidence. Everything else is just guessing.